Welcome to Property Banter by Pinnacle Buyers Agents. My name's Michael Ležaja, and in today's episode, we're talking about the 5 rookie mistakes that I see investors making in 2025 and how you can avoid them. Let's go. Now, 95% of property investors who invest in property only ever make it to 1 or 2 investment properties. Now, 95%. So the 95% of property investors only have 1 or 2 investment properties. And the reason for that is a lot of them are just chasing that one extra investment property that's going to maybe save them some money on tax. They've probably been told this by their accountant, their financial planner, or a property spruiker who's advertised 3 tax-saving hacks on how to get money back off your tax return if you buy an investment property. Well, they put you into a brand new property. They make a commission off you on the back end from the developer, usually 30 to 60 grand, and they sell you that tax-saving strategy. Now, what it does, though, is it puts you in a position where you're a property investor now with 1 property investment or perhaps 2. But what it's done is those properties are now calculated against your serviceability. So the bank, or when you go to your broker to assess your serviceability with a wide range of different lenders, most lenders will look at it negatively if you're on an average wage. So the average Australian only really ever gets to 1 or 2. And sometimes the average Australian who does invest in real estate and has 1 or 2 wouldn't mind going to 2 or 3 or 4, but they can't. And the reason they can't is because they're capped. Their servicing is capped and the banks won't lend them any more money based on their payslip or based on the income that they're earning, either individually or as a couple. So what's happening there is they can't get any more money, so they can't go buying property number 3 in their own name and 4 in their own name because it's done. They're capped out. Now, obviously, like I said before, this isn't financial advice. This is just in my experience because I work with investors on a daily basis. This is all I go through. I go through these conversations nonstop, hour after hour, and it's a common theme that I'm seeing. And the investors who are taking action and utilizing trust structures and other entities and not buying in their personal names because they're not focused on the tax advantages. The tax advantage isn't really an advantage. It's a disadvantage. The tax is an outcome. It means at the end of the year, you get a little bit more tax back, but in reality, you're giving away your serviceability. What you don't want to do is give away your serviceability. You want to protect your serviceability. And then what you want to do before you max out and you buy 2 properties, and let's say on an average income, you might be on a combined income of $170,000. I'm just throwing out random numbers here, for example. One of you is earning 100, the other one's earning 70 or 80 or whatever it may be. That amount of money, once you get to that investment property or second investment property, you're capped out, you can't borrow any more. But if you didn't get to that second property, and before you've started your property journey, if you turned around and said, look, I'm not really fussed on the first homeowners grant, I'm really interested in rent vesting, so I'm going to rent in Sydney, I'm going to scale a property portfolio, and you set up a trust structure or entity structure, there's a whole range of them. You've got to consult your financial planner, tax accountant for the exact setup that suits you and what you're looking to achieve. But if you go and set that up before you max out your borrowing capacity with the lenders, you will achieve a lot more than just 1 or 2 properties and a tax saving outcome. Now, those 1 or 2 properties are going to go up in value, right? So they're going to make money. But the real money's made when you have a large portfolio. So you have 1 or 2 properties, cool. You bought 1 or 2 investment properties that could be worth anywhere from $800,000 to $1.5 million in investment properties. That's your total portfolio investment if you buy 1 or 2. But if you go and you buy 10 properties at $500,000, that's a $5 million portfolio. And if that $5 million portfolio is going up at 10% per annum versus the $1.5 million portfolio of 1 or 2 properties at 10% per annum, obviously you're going to make money having 10 properties at a $5 million total portfolio value. So the point is to get a larger asset base and have a larger amount of good debt, essentially, because good debt is what amplifies growth. Right. And that's why we love property, because we can leverage, and that's why we go ahead and look at the trust structure earlier on. And the more successful investors that I see, and Nick is one of them, right? Nick's on about 9 properties now. He's about to buy his 10th with us. We're going to have him on the podcast soon. He utilizes trusts in his borrowing. There's a new trust for each property, right? And yes, there are some negatives with it, though. You do have to pay an ASIC fee each year, multiple ASIC fees each year. You do have to pay an accountant to run the trust, right? So there are fees associated with it, but the benefits of having, a 9-property portfolio and $5 million worth of assets going up in value, you've literally set up your future there. And the benefits of that capital growth on a solid total portfolio value of, let's say, $5 million, because we're using that as an example right now, far outweighs the cost of paying an accountant to run it and far outweighs the cost of an ASIC fee. I think the difference is, with a lot of investors, the ones who are very successful utilize trust structures and entity structures before they max out their borrowing capacity in their personal names. And they also don't look at the small things. They look at the big picture. They're looking at how much money they're going to make in future. And they play the game of property, right? This is how the wealthy do it. This is how the elite do it. This is how the 1% do it, right? So don't get too caught up in, oh my God, I paid this much tax last year and I really want to cut that tax bill. Don't worry too much about the ATO. The ATO, that's their job. Their job is to take money from your job, right? But it's yours to go make more money. It's your job to go make money for your family. It's your job to make intergenerational wealth so that your kids can live well. And by doing that, you need to leverage, you need to buy assets, you need to be super successful as an entrepreneur in business. But if you're not, you need to buy property and you need to buy assets and you need to create wealth. And the ATO is always going to be there. They're going to be there for their cut if you're earning $60,000 a year or if you're earning $6 million a year. They're going to be there for their cut, and that's just a given. But play the game of property. Don't deny yourself the game of property by just looking at tax-saving strategies and doing it in your personal name. The personal name thing that everyone is doing to get the tax outcome is totally wrong. In my opinion, I'd definitely be looking at utilizing trust structures and entities sooner rather than later, so it doesn't impact you and you can go on and scale. Now, if you've already bought 1, 2, 3, 4 properties in your own name, this is quite common. I see this as well, but you're maxed out your servicing. Sometimes people max it out at 4, whatever. Everyone is different, but you may need to sell down some assets just to regain borrowing capacity back and then go again. So it's better to set it up properly before you get started, have a plan, know the end goal of where we're going, and set it up properly to get there. I think that is the best and most efficient way. And if you avoid that mistake of buying in your personal name, you won't get trapped. Chasing equity at the expense of cash flow. This is another one that I see, and I see a lot of experts talking about chasing. You really need to get capital growth. Now, capital growth is important because if you've got one property and one property only and you've just saved one deposit, well, you can't buy 2, 3, and 4 yet. That property needs to go up in value. Now, you either need to manufacture that through renovations, additions, subdivisions, and so on that property, and then obviously extract that equity and go again, or that property needs to go up in value. Okay? So the gaining of equity through that property rising in value is super important. Location is very important at this point in time. Also data set, because that's what's going to go, the property's going to go up in value and then you're going to extract your equity and you're going to buy the second one. So we really need a lot of capital growth to kickstart our portfolio journey. But let me explain it. Let me break it down. Capital growth makes you rich. Cash flow allows you to hold the asset. So the cash flow allows you to hold an asset without it sacrificing too much of your week-to-week lifestyle. Now, you can go out in Sydney and buy yourself a property at $700 a week negatively geared. That $700 a week is going to come out of your pay. And if you're earning $1,800 a week, straight away, write off $700 as the negative that you're going to be paying after you factor in the rent and so on. And then you've got mortgage, property management, all the expenses, council rates, and so on. You'll pay $700 a week. For example, I'm just throwing out numbers randomly, but that $700 a week negative, you are working for that property. That property is not working for you. Hence why I love positive cash flow properties where the rent covers the mortgage and all the expenses and outgoings, and then let's say you're left with $20 positive in your pocket each week. You don't have to work from or put money from your weekly wages, from your business, towards that property on a week-to-week basis. And this can still be had. And in my experience, cash flow properties that are cash flowing really, really well. We're talking 6%, 7% properties like Darwin is currently showing, or Darwin currently has in 2025 is just like the old days. And this is how we used to scale portfolios back in the day, because we have good serviceability, because the property pays for itself, and we look to buy properties that pay for themselves and that aren't negatively geared. We don't look at the 2% or 3% yielding properties. We look at the ones with good cash flow. And I believe you can have a mix. So a lot of people are struggling right now because we did have a lot of interest rate rises over the last few years. And those interest rate rises have affected not just borrowing capacity, but they've affected a lot of people's bottom line and their ability to hold properties. So a lot of properties are negative. And a lot of cash flow spreadsheets, when we analyze properties, Brisbane, Melbourne, Sydney, they're negative cash flowing. So when you look at the rent and you look at all the expenses like mortgage, council rates, property management, and so on, these properties are negative $200 to $300 to $400 a week. Yet in Darwin right now, it's positive cash flow. In Cairns, it's a very minimal negative. It depends on where you're buying. I believe with the right data set, though, you can have a balance of equity, growth, and you can have cash flow as well. I think it's still out there. You've just got to move away from the big city mindset. And as interest rates are cut now anyway, you will see a lot of, cash flow spreadsheets start to move closer to neutral, right? So in summary to that, can you have your cake and eat it? I believe you can. And when you look at one of our latest reels, if you follow us on socials, if you don't get on there, there's some great information we're putting out all the time. But if you have a look at that latest reel where I talk about Cotality's July 2025 capital city release, it talks about, I think Sydney was up 0.8, Adelaide 0.7 for the month of July, Brisbane up 0.7 for the month of July, Melbourne up 0.4%. It's the lowest performer of all of them with the worst cash flow, in my opinion, well, second to Sydney. And you look at that, pales in comparison to Darwin's 2.9% price rise for the month of July. And in Darwin, you've got your cash flow because you've got houses for $600 and $650, renting for $750, $800 and $850 a week. The cash flow is amazing. And the last time I seen that type of cash flow with that type of affordability and that type of data set was Perth, was Townsville, right? There's a stigma around Darwin because a lot of people have a stigma around it. But that being said, people had a stigma around Perth. So it's just a common thing that everyone goes through because they're not analyzing the data, they're not being impartial, and they're not being analytical enough. They're allowing emotions to override. And I believe that you have a look at Darwin and areas like Cairns right now where we're buying. They are some amazing properties there where you can have your cash flow and your capital growth as well. Listening to the wrong experts. Now, this is one that I hear quite often. Every day, someone comes to me with an opinion that they got from somebody. And I can't explain this, and might come across a little bit cocky or like a smart ass, but I don't give a flying fuck what anyone's opinion is. It's quite interesting because the opinions vary and the individual doesn't even know why they're placing a lot of weight on that individual's opinion. And I think we get caught up in valuing someone's opinion because we value them. So, for example, someone might call and say, oh, my uncle said this. Oh, my parents said this. My parents said, don't buy townhouses in Brisbane because they don't go up, because they knew someone who bought for a period of 6 years and it didn't go up. Everyone knows someone that's done something. I know someone's been in a car accident. That doesn't mean I tell them, don't drive a car. Things happen. Everyone's got an opinion, but you need to block out the noise. The thing is, family and friends aren't experts. We just tend to value their opinion because we love them. And that's a natural human behavior, right? But we need to not listen to friends and family unless they're super successful, unless they're the number one developer in the country, then take development advice from them. If they've built a 50 property portfolio, take advice from them. But in general, if they haven't achieved anything, don't value their opinion just based on the fact that you value them. The other thing that I'm seeing is spruikers and project marketers. Now, this is one where you need to really take a good look at whether you're paying for a product or service or you are that product or service. And it's kind of like Facebook, right? Facebook is free for you. Why? Because someone pays on the back end companies like ours, we pay money to Facebook to market. A lot of companies pay to market their product and whatever business they're in, they pay to Facebook. Facebook makes a lot of money through marketing, through advertising sales, but you get it for free. So you're the product. The same goes for project marketers and spruikers. A lot of these project marketers and spruikers, they get paid 30, 40, 50, 60K. So I've heard up to $90,000, depending on what they're selling you. They get paid that money to sell you the property that they're selling you. So you need to be careful of this. A lot of these companies come at you, funnily enough, through their Facebook marketing or whatever platform they're using. They come at you as, hey, we've got tax saving strategies for you. Hey, if you buy this brand new property, you can save $12,000 a year on depreciation or whatever. They will come at you with a way in which they're helping you, but understand they're getting paid on the back end. So know that whilst they come across as your help, you're not getting it for free. No one's there looking out for your financial your situation. No one's looking out for you and your success absolutely for free. Nothing in this world is for free. So if they're getting paid on the back end to help you or to come across like they're helping you, you're the product, and those products that they're selling are inferior because they're loaded, and quite often they're not worth what they're worth. It's way better to buy a property that is existing, that's not brand new, where you're not running down the tax saving strategy and you're actually buying it based on data in an area that suits. We are buying different areas all the time for different clients based on the strategy because data changes all the time. What you buy 6 months ago, you might not buy today, right? Because markets change all the time. Whereas these property spruikers, they make a deal to sell an entire apartment block or whatever it may be, and that entire apartment block, they've got to work on just getting that sold out. So when you say to them, hey, I want to save on my tax, like I just seen in your ad, they're going to present you with an option. That option is going to be the option that they have on file, the option that they've negotiated with the developer. That option isn't based on 15,300 different suburbs in Australia that go up at different times based on your circumstances, the way we do as buyers agents, right? So you pay us as buyers agents, we work for you, we ensure that you have the right strategy, and then you go buy the right data set area and you make the money, just like I talk about in our recent Darwin podcast where we discuss how we're absolutely killing it for our clients, and a lot of our clients are up 100K in 6 months. Now, I'm not advocating get rich quick. I'm just saying, we get good results, but you pay us for those results. That's how we get paid. We work for you. Just be careful of those who you don't pay. They don't work for you. Following media hype. Guys, by the time there is a huge lag between the time that we adopt a market, then by the time other buyers agents adopt it, then the general population, and it shows up on the results as, hey, this area has performed really well last month, and then the media picks up the story and so on. That's 6 months to 9 months. So for example, Darwin just popped up as the best performing major capital city in Australia in July. We were buying there in January. So 6 months ahead, just before everyone knew, just before the majority of buyers agents arrived, right? So by the time you hear about it in the media and you're getting the media hype, you are late. You're $100,000 late. So let that sink in. The goal here is to utilize the data and be ahead of the game all the time. Then by the time everyone's in that market, we're already on another market. So we're always ahead of the game. We did that now in Darwin in 2025. We did that last year and a half ago. We were in Melbourne. We were buying the cheapest stock in Melbourne before there was any buyers agents on the ground because we knew that all the buyers agents would be on the ground now, and they are. We went to Perth 2022 before everyone went to Perth. We were in Brisbane pre-COVID. We were in Sydney early 2010s. So it's just recognizing patterns and data and just moving around to the market that's best performing at the time. And you decide whether you want to go there, but you'll have that advice from us. So be super careful about following the hype. Ignore the hype, work on data and facts. No strategy or exit plan. This is something I see quite often. And you need to have an exit strategy in place for each of your properties. Whether you're going to, what's your entry exit timeframes? Are you going to sell them? You're going to granny flat them? You're going to paint it, sell it to an owner occupier? What is your individual exit strategy for each property? How does it sit in your overall portfolio? And what's your entire portfolio roadmap to the end? Are you building something? Because you don't build a house without a plan. You don't sit in a car and go somewhere, but you don't know where you're going. You already know you're going to the shops. You already know you're going to work, right? So you know where you're going before you sit in the car. Well, property investment is no different. And the most successful investors know what they're trying to achieve, and they have a plan and they're executing to that plan. Now, that plan does change. You review plans, you change plans, and so on. Because as you go on, you get more equity, you become more successful, and the goalposts get moved. And that's okay. But you still need a plan to know where you're going and what you're looking to achieve. Now, if that is, I want to earn $150,000 passive income because I'm going to quit my job, I'm going to lay on the beach in Bali, that's cool. You can set up a plan to do that, right? If it is, I want 10 houses. Some people come to me, I want 10 houses because I want 10 houses. Some people come to me and go, I just want to buy a house and refinance it so I could buy an AMG. Like I hear all of them, right? And it doesn't matter what it is. There's people out there that want to just buy each of their kids a property. And I love that one, right? The plan is to just buy each of them a property so that they've got a way to get in the market in future. So whatever it is something that means something to you, and we need to know where we're going so we can plan the best way to get there. And I can utilize my experience in portfolio building and 11 years in property acquisitions, 20 years in investment, so that I can give you the best possible plan in order to get you there in the fastest possible route, kind of like a GPS, right? So that's what we do. Okay, I'm going to throw in one bonus mistake. This is one that I see quite often. And we had a plumber, and this plumber has a successful business. That successful business has put them in a position where they have roughly $3 million worth of cash sitting, but they are struggling with taking the leap and buying property. So for whatever psychological reason, they have a fear of investment. Now, some of you watching this would probably watch many, many different podcasts, and you might not be the type of person that takes a leap. You might be the type of person that's very cautious and really analyzes things and jumps into analysis paralysis, because you can analyze things multiple times, but then it just becomes analysis paralysis, right? So that was a tough one to get out, even though I say it every day. But it's one of those things where you're in such a good position at $3 million cash at bank that you can't buy an investment property. You're struggling. But yet I've got people that have $350 or can borrow $350,000 and are on the tightest of budgets going, please, what can I buy? I just want to get into the market. So you've got people with no money that just want to get in. And then you've got people with plenty of money that are on the sidelines. There is nothing to be had sitting on the sidelines in this game. You will constantly miss out over the course of my life and my career in real estate. I've never seen it go down. I'm not saying that it won't crash one day. I'm saying everything happens at every point in this world, in this crazy world. But to not play the game and to continually watch property go up is one of the biggest mistakes that I see people make on the sidelines. So if you are umming and ahhing on the sides, get in, take action. And even if it is something smaller, even if you, for example, don't have the $3 million and you've got $2 million, just buy a $500,000 property. You don't have to spend all your money if the cash is so important to you. Just take the steps, make it happen, take action, and you'll be better for it. If you're unsure about your personal situation, your own portfolio strategy, gaining some clarity around, how you could potentially do it when it comes to property acquisition, that's what we specialize in, and scaling portfolios. So please reach out to us. We'd love to chat and help you get that clarity. Of course, we have relevant experts in their field that specialize in the financial planning, the setup of trusts, and so on. We refer to them. We don't provide any of that advice, but we have the team in place, whatever it may be, from mortgage brokers to tax accountants to financial planners, property management, the whole team we have. And if you are looking to build a portfolio, get in touch with us. We'd be happy to chat. I hope you enjoyed this episode of Property Banter. Thank you so much for joining us. And until next time, take care.